In the last 48 hours, a signal that usually moves like a slow tide snapped like a tension cable. The spread between the 10-year and the 2-year U.S. Treasury yield surged toward roughly 72 basis points. That is not a quirky chart. That is the market's internal geometry changing shape. And it changed fast. Not months, not weeks, in days. The kind of move that forces risk models to redraw assumptions, forces dealers to reprice collateral, and forces anyone who depends on normal to admit they are now trading a different environment. Because here is what makes this moment unsettling. The stock market is busy printing celebration banners, big round numbers, record talk, confidence narratives. Meanwhile, the bond market, the market that finances everything, has been quietly rewriting the long end. That contradiction is the story. The surface says all clear. The plumbing says pressure. And when the plumbing starts speaking, it does not do it in speeches. It does it in spreads, auctions, repo conditions, and the way the curve twists. This chart pattern has not shown up like this in years, not at this speed, and not with this mix of catalysts. The reason it matters is simple. Historically, when the curve steepens violently after a long inversion, the next chapter is rarely gentle. It is usually a rotation, a reshuffling, sometimes a repricing that feels orderly in hindsight and chaotic while it is happening. What I am about to lay out is not opinion. It is a chain of observable moves, specific dates, specific numbers, specific institutional behaviors. If you have been watching markets through price alone, this will feel like seeing the wiring behind the wall. And once the wiring is visible, the room makes more sense. Welcome to Macro Decode, where we translate the market's hidden language into plain English before it becomes the headline everyone repeats. If you get value from calm, data-driven breakdowns like this, consider subscribing the way you would keep a wise elder in your circle. And leave a comment with where you are watching from, because it helps this channel find people who want to understand, not just react. Now let's get forensic about what actually happened. On February 6th, 2026, U.S. equities celebrated. 67 after a sharp up day. That number is psychologically loud. It makes it feel like the system is confident. But at the same time, the bond market was doing something more consequential, 72%. A year ago, that same spread was deeply negative, inverted for one of the longest stretches in modern history. The inversion era trained people to think in a certain way. Invert equals warning. Uninvert equals relief. But the curve is not a mood ring. It is a pricing mechanism. And this particular UN inversion has fingerprints that do not look like a simple relief rally. Re-steepening can happen for good reasons or bad reasons, and the market does not label which is which. You have to read the drivers. The good version is when short-term rates fall because the central bank is cutting, while long rates fall too, just less quickly. That can signal easing and stabilization. The bad version is when the long end rises because investors demand more compensation to hold duration. Heavy supply, sticky inflation risk, rising term premium, or uncomfortable fiscal math can all push the long end higher. That is not a growth party. That is a price of risk moving higher. What the market has been doing lately looks much closer to the second version. And the speed is the tell. Over a short span, the gap widened at a pace that even institutional market data desks flagged as unusually fast, roughly 10.4 basis points in about 8 trading days. Speed matters because it changes who gets forced to act. Slow moves allow adjustment. Fast moves create adjustment. So what is driving it? Start with the calendar. Early February is not random. It is when Treasury refunding communications, borrowing estimates, and auction schedules collide with a market trying to price the year ahead. Treasury borrowing expectations have been floating around numbers that remind you this is a supply story as much as a growth story. A borrowing estimate of roughly $574 billion for the first quarter is not background noise. It is a statement about how much paper needs to be absorbed, and it sets the stage for how hard the market must work to clear supply. Now layer in the next catalyst, the institutional world watches obsessively. The auction cycle. A 10-year note auction scheduled for February 11th, 2026 is not just a date. It is a stress test. It is where demand for long duration is revealed in real time. If the auction clears smoothly, the market exhales. If it tails, meaning buyers demand a higher yield than expected, the curve can steepen further, and risk assets can suddenly realize the cost of money is not a theoretical number. It is a number that clears at a specific yield for a specific amount of bonds, with real balance sheets on the other side. Here is the central mystery. If stocks are so confident, why is the bond market pricing the long end as if it needs more compensation? If growth is strong, why does the market keep talking about supply and term premium instead of... In the last 48 hours, something happened that breaks the way most people think markets work. A system that claims it can price anything, anytime, with infinite liquidity, is now leaning on a very old constraint. You cannot settle a promise with another promise when the other side demands the thing itself. $467 trillion, represented by roughly 732,649 standard bars. And in the same official snapshot, London holds 27,729 tons of silver, valued near $92 billion, represented by roughly 924 hours with 304 bars. These numbers are not trivia. They are the foundation of a market that pretends paper and physical are interchangeable until the moment they are not. They said this could never happen. They said modern finance solved the old problems. They said if you want exposure, you can buy a contract, an ETF, a certificate, a claim, a proxy, and it's all the same because the market is deep and efficient. Yet the data is telling a different story, not months from now, not weeks. In 48 hours, you can see the outlines of a squeeze that is not just about price. It is about priority. It is about who gets metal when everyone remembers metal is the point. And the most uncomfortable truth is the information gap. Institutions see vault tables, settlement terms, and official reserve decisions as signals. Most people see a chart and a headline. By the time the headline arrives, positioning has already happened, and the rules have already been rewritten in small print. What I am about to reveal changes how this whole market should be interpreted, because it is not about sentiment, it is about structure. Welcome to Signal and Ledger, where we decode what matters before it becomes the story everyone pretends they saw coming. If you have watched markets long enough, you know the loudest voices arrive late. Here we focus on inventories, balance sheets, and incentives. If that feels like listening to a calm elder in a noisy room, stay with me. And drop a comment with where you are watching from, because this is a global story and it moves through different time zones in different ways. Now let's reconstruct what actually happened, because the details matter. At the end of January 2026, the London Vault System reported 9,058 tons of gold and 27,729 tons of silver, 57% month over month, 3%. To most people, that reads like routine inventory drift, but in a market built on confidence, small percentage moves can hide large, targeted reallocations. It is not only how much sits in a city, it is who owns it, how it is held, and what is considered available when stress arrives. To see why the market feels normal right up until it does not, translate those numbers into real constraints. 4 kilograms. Multiply that across roughly 732,949 bars, and you are looking at an ocean of metal, but an ocean divided into zones. Some bars sit in allocated accounts with specific owners and specific bar numbers. Some sit unallocated, effectively a claim on a pool. Some are pledged as collateral against financing. Some are tied to operational needs that cannot be disturbed without consequences. So the headline number can look stable while the functional availability tightens. Silver is even more revealing because the physical reality is heavier, 1 kilograms. The London count of roughly 924,304 silver bars sounds abstract until you imagine pallets, forklifts, assay checks, insurance, and transport schedules. 467 trillion. Yet the logistics are more burdensome and the industrial draw can be less flexible. In other words, silver can look plentiful on paper and still feel scarce in the places and forms that matter. Here's where it gets interesting. Vault numbers are often treated like a scoreboard, but they behave more like a map. Gold rising slightly while silver declines slightly is not a simple bullish versus bearish signal. It can be a clue about what is being prioritized for strategic reserves, for collateral quality, and for settlement assurance. When metal is being pulled from the market quietly and fast, it rarely shows up as a dramatic single-day headline. It shows up as changing terms, changing preferences, and changing urgency among the players who actually move size. The central mystery is this: why would the official world behave as if physical metal matters more, while the price discovery layer still trades it like a leveraged macro bet? If the market were perfectly efficient, those two realities would converge. But they are not converging, they are diverging. And that divergence is where dislocations are born. To understand what is unfolding, you have to look backward, because this playbook is not new. In the 1970s, after the dollar's link to gold was severed and inflation proved it could survive official denial, gold stopped being a dusty relic and became a referendum on policy credibility. The result was not just higher prices. It was a reshuffling of trust. Confidence migrated away from promises and toward things that did not require a counterparty to perform. Then, fast forward to 2008. Different trigger, same core issue. A system built on layers of claims discovered that correlation goes to 1 when stress hits. What followed was not merely a crash and a recovery. It was a regime shift in how institutions thought about liquidity, collateral, and tail risk. Gold's role changed again, not because people suddenly loved shiny metal, but because balance sheets needed assets that could survive a chain reaction when counterparties failed. Now look at 2020, when the world learned that even deep markets can choke if transportation, refinery output, and delivery logistics are disrupted. When flights are grounded and refineries are constrained, the spread between where metal is and where it is needed becomes the story. That episode was not primarily about fear of gold's value. It was about moving metal through a system that assumed frictionless mobility. That assumption is always hidden in the background, and it resurfaces whenever real-world constraints collide with paper expectations. And now look at the post-2022 regime and the years that followed. The headline theme has been inflation, rates, and geopolitics, but the deeper theme has been the return of settlement risk and reserve politics. When access to reserves can be questioned, when payment rails can be weaponized, and when sovereign balance sheets are being reevaluated, official actors start to behave differently. They start to prefer assets that cannot be frozen by a counterparty and cannot be printed by a committee. That preference is not theoretical. In 2025, central banks bought a net 863 tons of gold. In the fourth quarter alone, net purchases were about 230 tons, a 6% acceleration from the prior quarter. Central banks do not chase momentum the way traders do. They accumulate when they are insulating the system against something they do not want to name. And one buyer stands out. The National Bank of Poland added 102 tons in 2025, the largest net buyer for the second year running. That is not a short-term trade. That is a statement about what kind of asset will still matter if the system becomes less predictable. This is the part many people miss. Official sector accumulation changes the texture of the market. It is slow, persistent, and indifferent to daily noise, and it competes directly with the structure of paper supply. Paper markets can create exposure with a keystroke. Physical markets cannot create bars with a keystroke. When official buyers remove float, it does not come back quickly. It is not recycling through speculative hands. It is being parked. Now, who are the players and what are their incentives? Start with the vault networks and the clearing structure. London's bullion market sits at the center of global wholesale flow. It is where large positions are allocated, stored, and moved through a web of custody relationships. But within that ecosystem, bars are not identical in practice. Some are encumbered, some are earmarked, some are sitting in accounts that are designed for liquidity and cannot be easily disturbed. Others are in accounts designed for safety, which can be disturbed but only at a cost. That is why a single inventory figure can hide a more important change, the share that is effectively locked. Then add the central banks, the official reserve managers, and the sovereign funds. Their objective is not quarterly performance. Their objective is continuity. They care about what works under stress. That is why reserve composition matters more than price commentary. One striking summary of this shift is that gold has risen to around 20% of global official reserves, ahead of the euro near 16%, with the dollar still the largest, around 46%. That is a quiet rebalance in the most conservative portfolios on Earth, and it signals a preference for assets that do not depend on someone else's promise. Next, consider the exchanges and the derivatives layer. Futures markets, options markets, and synthetic structures exist to provide liquidity, hedging, and price discovery. They are useful, but they also multiply claims. In calm times, that multiplication looks like efficiency. In stressed times, it looks like leverage on top of leverage. The system functions because most participants accept cash settlement, roll positions, or net out exposure. The system strains when enough participants ask for conversion, because conversion is where paper meets the limits of physical reality. And then there are the commercial banks, the bullion banks, the market makers, and the financing desks. Their business models depend on spread, turnover, and confidence in the plumbing. They manage inventory, leasing, swaps, and collateral transformation. None of that is inherently dramatic. It is how modern wholesale markets operate. The risk emerges when the underlying asset becomes more desirable than the claims built on it. That is when the plumbing becomes the story. So where is the dislocation? It is between how metals are treated in official reserves and how they are treated in day-to-day trading. The official world is accumulating gold as if it is insurance. The trading world is still pricing metals as if they are a speculative sidecar to rates and the dollar. Those can both be true for a while, but not forever, because they imply different scarcity assumptions. Insurance demand is not price elastic in the same way as speculative demand. It does not disappear because a chart looks overbought. It persists because it is a response to structural uncertainty. There is also a dislocation between paper abundance and physical specificity. A futures contract is standardized. A bar is specific. It has a refiner, a serial number, a location, and a chain of custody. When markets are calm, those details are background noise. When markets are stressed, those details determine whether a claim can be satisfied. Two markets can print the same price, while one market is quietly rationing actual supply through delays, premiums, and stricter terms. That is how a gap forms between what is quoted and what is obtainable under pressure. Now let's put numbers to the evidence, because narrative without numbers is theater. $467 trillion. That is not a niche corner. $467 trillion, is a scale that competes with the largest asset categories and forces policymakers to pay attention. Pair that with roughly 732,749 gold bars, and you begin to see the real point. If a relatively small fraction of holders decide they'd prefer allocation, the operational capacity to satisfy that preference becomes a constraint. Now, silver, 27,729 tons, roughly 924,304 bars, valued near $92 billion. Notice the contrast. The tonnage is massive, but the valuation is far smaller than gold's. That encourages leverage behavior because smaller notional markets can be pushed around more easily. Yet the physical logistics are heavier, and the industrial tie-ins mean supply cannot be conjured instantly. Silver can therefore swing between too much and not enough, depending on where it is, what form it is in, and whether it is already committed to fabrication. Then add the official flow, 863 tons of net central bank gold purchases in 2025, with 230 tons in Q4. Again, this is not day trader flow. It is balance sheet flow. It has a different cadence, and it has a habit of appearing as mysterious resilience when price action does not match sentiment. When official buyers are steady, dips that would normally flush out demand can instead become opportunities for long-term accumulation, tightening the system quietly. Now compress time, because this is where the quietly and fast part becomes real. In a calm market, a large holder rolling a paper position forward is a routine click. In a tense market, that same holder asks a different question. What if the roll is there, but the exit is not? That is how 48 hours becomes the window where a quiet decision turns into visible stress. It can start with one desk deciding to convert exposure into allocation. Then a second desk notices a tighter quote. Then a third desk sees the same reluctance to offer size on the same terms. The price might not move first, the terms move first. Now here's the mechanism that turns these facts into a market event. It is not magic, it is incentives. Imagine a theater where there are far more tickets in circulation than seats, because most nights not everyone shows up. The theater runs smoothly, tickets trade, everyone is satisfied. Now imagine a night when attendance spikes and people actually want seats. The theater does not collapse because someone is villainous. It collapses because the assumptions changed. The seat is the bar. The ticket is the claim. In metals markets, the extra tickets are paper claims, futures contracts, unallocated accounts, shares that represent metal held in custody, and structured products that provide exposure without physical movement. In normal conditions, those claims net out. In stressed conditions, some holders convert claims into allocation and allocation into withdrawal. That is the pull. It does not require panic. It only requires enough participants to decide that optionality is worth more than convenience. How is it executed in practice? Often through subtle policy shifts and cost changes. If margin requirements rise, leveraged positions become expensive to hold and forced selling can appear. If financing rates change, carrying inventory shifts from profitable to punitive. If warehouse rules or settlement incentives change, the cheapest deliver dynamic shifts. None of this has to be dramatic. The machinery can do the work quietly, one constraint at a time. That is why people miss it. They look for a single news event while the market is responding to a chain of incentives. There's also a psychological mechanism that accelerates it. When a few sophisticated players demand allocation, others infer that allocation is becoming valuable. That inference spreads faster than official reports. It shows up as a change in behavior. Shorter settlement windows, tighter collateral haircuts, more demand for specific bar types, more insistence on audit trails. These are not dramatic headlines, but they are the language of a market preparing for stress. Now connect the dots between seemingly separate events. Official reserves tilt toward gold. Vault inventories show selective changes. The derivatives layer continues to trade enormous notional exposure. The result is a growing sensitivity to delivery stress. You can see it in the way certain forms of metal command attention, in the way immediate terms become more expensive than later terms, and in the way internal institutional conversations shift from price to availability. When that shift happens, a market can look liquid right up until it is asked to perform under pressure. This is not opinion, this is pattern. Whenever a system built on claims meets a period of stress, the hierarchy of claims becomes visible. The most senior claim is the asset in hand. Everything else is a promise to deliver it, or a promise to pay for not delivering it. For years, the market has been comfortable with the idea that cash settlement is good enough. That comfort evaporates when the purpose of holding metal changes from return-seeking to risk mitigating. Insurance is not satisfied by a check if the risk you fear is the check itself. One more layer makes this sharper: collateral. In modern markets, the best collateral is not whatever has a high price. It is whatever can be trusted instantly, valued consistently, and delivered without dispute. Gold has a unique status here. It is dense, divisible, and globally recognized. In a tightening environment, institutions prefer collateral that survives margin calls without questions. That preference can pull bars out of the available pool, even if they never leave the vault, because they become tied to credit lines, swap books, and liquidity backstops. That is also why you sometimes see strange calm on the screen. A quoted spot price can look stable, while the cost of certainty rises. The market is not only pricing metal, it is pricing confidence in delivery. When confidence is abundant, spreads are tight, and most participants accept convenience. When confidence is scarce, spreads widen, settlement terms stiffen, and value migrates from exposure to possession. That migration does not announce itself. It shows up as small frictions that compound into a regime change, and once that shift starts, it tends to feed on itself. The first movers get the easiest terms. Later, movers pay in time, spread, and restrictions. That is why the pull is quiet at first, then suddenly obvious. Markets reward early certainty seekers. So what does this mean going forward? Historically, when official sector accumulation stays elevated and the availability of deliverable metal tightens relative to paper claims, one of three things tends to happen. The conservative scenario is gradual adjustment, higher carry costs, more frequent episodes, where nearby delivery commands a premium, and a slow repricing of physical terms, while paper volatility remains episodic.